Welcome. I want to officially welcome everybody that's just joined the room. This is part of Mayan Riviera Properties webinar series. So we have this ongoing webinar series with all sorts of topics that are of interest to expats that either own, live, work in Mexico. And today we are going to be talking about the considerations for US citizens who own, live, work in Mexico. And I'll introduce my co-hosts in just a moment. They have been kind enough to join us today. But let's go ahead and get started. For those of you that don't know me, I'm Amber Pierce. Nice to meet you. I own Mayan Riviera Properties, which is in Puerto Morelos, Mexico. And I know a lot of the people that join in to these sessions are Puerto Morelians themselves. They've seen some of our local advertising, but a lot of times people pick these up on forums and things for expats. So if we haven't met before, hello. It's nice to meet you. Puerto Morelos is near Cancun. If you don't know where I'm at, that's where Puerto Morelos is. What I do at Mayan Riviera Properties, I'm a broker there. I've been selling real estate in Mexico since 2006, and we do property management, real estate sales, obviously, and then also vacation rentals. And I am a federally certified agent, and I'm also a member of A.M.P.I and NAR. So if you have any questions, certainly let us know. What I want to be able to do is very quickly, I'm going to turn over in just a moment the presentation to Joel and Loma. They've been kind enough to meet with us today. Joel and Loma are also going to introduce themselves, so I'm not going to spend much time doing it, but they are from Lurie LLC. It is a professional tax consultant firm in the US. I really, really appreciate their time and the efforts that they've put into helping us today. I know I'm interested to just get a refresh on this. I need to make sure my I's are dotted and my T's are crossed because I'm a US citizen that works and lives in Mexico. So I want to make sure I'm compliant. And so to get started, as we get started here, I just wanted to mention a couple of quick housekeeping items. If you've never been in one of our webinars before, your microphones are currently muted, okay? And that just keeps the background noise down. But Joel and Loma have both said during their presentation, if you have a question to ask, feel free to jump in. All you need to do is click your mic button and turn it on. You can ask your question and then just mute yourself back off again to reduce that background noise. The other option, if you don't have a mic handy with you, is there is a chat box, and you'll see where some people have been chatting in. Hi, Dave. I just saw your chat. Glad that you could jump on. So if you have a question, you don't have access to a mic, or you just rather ask it that way, you're welcome to jot any questions you have down in there. And at the end of the webinar, we're also going to open it up for questions as well. So if you're listening through and you haven't gotten your question answered by the end of the material, we'll leave some time for Q&A at the end. Okay, so with that, we're going to go ahead and get started. Loma and Joel, I'm going to pass the presenter baton over to you so that you can start your slides. It should be coming your way now.
Thanks, Amber. I'm Joel Lebowitz. I'm a partner with Lurie in Minneapolis. Today, I've been practicing here for 42 years. We practice with many individuals and businesses who have international activity, a lot in Mexico. I have a home in Mexico myself, and have experienced and had to learn all of the answers to all of the questions, hopefully, that you'll be asking today. And the person I learned them from is my co-presenter, Loma Ince. That's our first and last typo in our slide.
Oh, there we go. I just realized that.
And now you know why Loma made her way into international tax, if you just heard her accent. Mm-hmm. When she started practicing in the tax field in the United States, they decided that because she didn't sound like anybody from the United States, that she should be specialized in international tax. And I will tell you that in my 40 years of practice, she might be the finest international tax practitioner that I've dealt with. So she's blushing, which is why we don't have the camera on.
Thank you.
She's going to lead us through today, and I'll ask some questions and clarify some things for us. But thanks for joining us. And Loma, I'll let you give a little of your background.
Thank you, Joel, and yes, that was blushing. I've worked in the international arena my entire tax career, and again, it did start with I sounded funny, so therefore I must want to do international, and since I'd filed one Australian tax return, I had to be an expert. So that got me into the area of international tax, focusing on both typically U.S. outbound companies and individuals trying to do activity outside the U.S. I have also done the reverse or inbound planning and so forth. And we do have a number of clients that have found the advantages of Mexico, particularly the advantages of owning property in Mexico, particularly if you can get by the beaches and so forth. It's beautiful, and why would you not do this if you're able to make it work? So that's kind of my background area, and I've done expatriate taxes for, focused on it 100% for about 5 years in there, and then the rest of the time I'm sort of balancing everything that's going on. So I'll get started with key item that we want to stress for U.S. persons is that the U.S. taxes us on a worldwide basis. And first question I often get, because I always use the term U.S. person, is what is a U.S. person? And a U.S. person is an individual who's a citizen, a green card holder, or actually a resident here, spending more than typically 183 days in the United States. Those are considered U.S. persons. They're also business entities of any type that is established under U.S. tax law, so that's C Corp, S Corp, LLCs, LLPs. I'm sure I'm missing something. And then trusts established in the U.S. under U.S. law as well. So all of those parties are all subject to worldwide taxation.
So 2 questions before you go on, just to clarify. Number 1, somebody here with a in the U.S. with a work permit, yes or no?
They are considered to be U.S. residents if they've met the substantial presence test, unless their visa very specifically gives them non-residency status. That is typically students or like research workers, so
okay.
day ones and so forth.
Students was my other question.
Yes, so they meet the substantial presence test, but their days don't count. But that's sort of the exception. Otherwise, if you're here on an L1 visa and you meet the test, you're now considered a resident.
Okay. And then the second question is, you know, we heard a lot about with the new tax law that the United States was the only country, major player in the world that had a worldwide income system. Did that change?
Yes and no. In fact, the headlines all implied that it changed, that we were going to a territorial tax system. The fundamental of that is that does apply to a degree, but not for individuals. It is for C corporations only. So we're focusing on the good old-fashioned worldwide taxation system of the U.S. that we anticipate applies to everybody on the call today. So what does worldwide taxation really mean? It means you're taxed on income from all sources, regardless of where the payment comes from, where you deposit it. You're going to be subject to tax on that. Now, it doesn't mean you're subject to tax on it immediately. There are situations where there can be deferral of the taxation based on the facts and circumstances. The most obvious one is if you have business operations established in an entity considered to be treated like a corporation. For U.S. reporting, that income can be deferred until you actually get the cash, provided one of the 7+ anti-deferral rules don't kick in. So in most cases, it's going to be taxed as earned, and it doesn't matter how or where you are paid. It's based on the fact that you have earned the right to this income. And it doesn't, if it's foreign source income, it's still subject to taxation here in the U.S. Sourcing is always an interesting one, so I'll give some basics on sourcing. Sourcing for services is where is the work done. So an expat who works for a U.S. company that goes and is working in Mexico, their income is sourced to Mexico, even though they might be paid 100% still in the U.S. by their U.S. employer. Rental income is sourced where the property is located. So if you've got a Mexican rental property, it is foreign source income. Again, from a U.S. perspective, it's all income to you. If it's foreign source income, you've got the potential of eliminating double taxation through the foreign tax credit, which there are 2 main ways to eliminate double taxation. Foreign tax credits is the one that applies to almost all forms of income. If you have foreign source income and it is also being taxed in the other jurisdiction, then one of those jurisdictions is deemed to have the primary right to tax you, and the other jurisdiction then will allow a credit. So dealing with a U.S. person who has rental income in Mexico, for example, the Mexican government has the right to tax that income because it is Mexican source income. Doesn't matter what your residency status is in Mexico, it's Mexican source income. In the U.S., you would calculate your tax from a U.S. perspective on that same income and then compare that to the tax paid in Mexico and claim a foreign tax credit on that. It's the lesser of your U.S. tax or the Mexican tax. You can't get a refund in the U.S. because your Mexican tax liability is higher than the U.S. We wish in some cases, but you can't.
Couple questions. So you talked about the deferral. One of the questions I get all the time is, what about all these structures that can get you out of U.S. tax?
Typically, they're not getting you out of U.S. tax.
They're not real.
They're not, and if it appears that they really are getting you out of U.S. tax, I would say it's raising a red flag that something's not quite correct with the structure. I would do that. This is why we've had issues like with a lot of the banks now outside the U.S. and then being required to report U.S. owners because banks were trying to set up structures that would hide the income from the U.S. and it wasn't legitimate from a U.S. structuring perspective.
So 2 points I would make. The first is you can do it. You have to give up your citizenship. And when you do, and you take your money and you leave the United States, this is not something I didn't know, but I learned about half a dozen years ago. When you leave the United States, if you give up your citizenship, you're taxed on your built-in profits on everything you own when you leave.
If you got enough.
If you got enough.
Yeah. Yep.
That's number one. Number two, I think I would point out that, you talk about the elimination of double tax and the foreign tax credit and the deferrals and so forth. This doesn't really have to be all as complicated as some people make it, but some people make this taxation complicated because it serves their benefit. So by deferring, it becomes more complicated, right?
Yes.
By paying a tax credit in the current year, it might be inefficient, but it's not all that difficult, because all that means is if you have income in Mexico and you pay income tax on it in Mexico, and you pay income tax on it in the United States, you get a credit for your Mexican tax, and the credit you get is either the greater of the Mexican tax you pay or the U.S. tax that you would pay on the same income. So you really don't get double tax,
right.
And it's not all that complicated if you do it that way.
Correct. And typically, the issue actually can be for people is where they've gone and made it complicated, and now you have a timing mismatch where the income is taxable in one jurisdiction at a different time than the other, which makes it actually very difficult to claim the foreign tax credits or makes it more complicated.
But that's the kind of stuff that gets your head spinning.
That's right. That keeps me on my toes on a daily basis. So we'll talk a little bit about expatriates. So this is U.S. citizens or green card holders who are living and working outside the United States. So they've shifted their tax home outside of the United States. And this is a key area because now you've got the situation of earned income being taxed in both jurisdictions. As I said before, sourcing on earned income is where did you perform the service. So typically in most other jurisdictions, now you're still going to be subject to full tax in Mexico as well as full tax here. The foreign tax credit doesn't necessarily always provide maybe as favorable of an answer. So the U.S. they introduced another area where they can eliminate double taxation. And part of this is that since the U.S. is one of the only countries in the world that taxes on worldwide income on individuals, once they've actually left the country, or I take that back, that they tax based on your citizenship. As you see, I'm saying U.S. citizens and green card holders here. So just on that, they wanted to try and make it so it wasn't so burdensome to U.S. citizens who have gone overseas. The additional way of excluding double taxation here is called the foreign earned income exclusion. And essentially what this is to the degree that you have foreign source earned income approximately $102,000 or less in the calendar year. If you're there all year, you report all of your earned income, and then you can subtract either the amount you have or up to $102,000. So your income subject to tax in the U.S. is now being reduced. So for a number of expats, this might wipe out all of their income. They don't even have to think about the foreign tax credit. If their income is above that exclusion amount and they've paid foreign taxes, then they can also get a foreign tax credit on the remaining piece that hasn't been excluded. There is also a foreign housing exclusion, whereby if you're renting housing outside the United States, the government has accepted that often housing elsewhere is more expensive. So if the housing cost exceeds approximately $16,000, and generally if it's below about $30,000, that differential is also eligible for an exclusion, so you won't pay tax on it. It's basically an acknowledgement that your salary may have gone up solely because it costs you more to live there.
Is that rent only?
Yeah, if you own the property, it's now Schedule A, just like it is for somebody here.
And Schedule A means itemized deduction.
Itemized deduction.
So let me give you a fact pattern, and I don't know if he's in the room with us or not. So just in case he is, I'm not going to say his name. But he lives in on the east coast of Mexico, not far from where my house is. And he's a salesman, very successful. The company that he works with, frankly, is family owned, and he makes very good money, over an amount in excess of what would be excluded under what you just talked about. They bought a place in Playa del Carmen, and he works out of there using WhatsApp and Skype and every other voice over IP. And once in a while they come back to visit family, but that's where they live with their children. He maintains a bank account in Dallas, which is where his paycheck goes, and that's where his brother lives. Her family is from California, and so as far as they're concerned, when he called me to ask me what he should be doing, he said, I just want to file a U.S. tax return. And you say what to him?
I would say that he most likely needs to file a Mexican tax return because, again, he's actually doing the work in Mexico. He's being paid to do the work in Mexico, and it is an increasingly questionable thing where people are always questioning it because they may be bouncing around all over the place. But no,
how in the world would Mexico ever know that?
Well, the income tax treaty does allow for the U.S. and Mexico to share information, so there is actually an agreement in place that the two will. The Mexican authorities, he has a property in Mexico, they know about him. How is he just funding his lifestyle? If he has a bank account in Mexico that has other funds, at some point he's probably transferring money to Mexico. There are lots of different ways. The U.S. government, I know that if a transfer comes in from a foreign bank in excess of $10,000, the bank must report it to the government. So there are lots of ways to be found. Now, are there also lots of people who have never been found? Most likely, but we always advise you want to be compliant because the cost of not being compliant does have the potential of jail time depending on the jurisdiction you're in, or being kicked out of the country and now you've got assets you can't access.
So more and more we get these kinds of questions. Everybody hates paying U.S. tax, but here we're talking about the Mexican tax, which is not an insignificant rate. But we don't do those kinds of filings. It's easier and easier to find people like this. So as the techniques become more sophisticated, and they don't have to be too sophisticated. If you have a bank account in Mexico, Mexico knows you're there, or at least they know you have access to that bank account. What they do in the United States could easily be done in Mexico too. Credit cards. A credit card and the activity on your credit card will probably show where you are during most of your life.
Yes.
And and they can look at travel records, right? So it's not just it's not the sophisticated. We talked earlier that when we're going to talk a little bit about rentals, but Airbnb and VRBO, I mean, if you're renting your place, they know you have an address and they know where it is. And if it's in Mexico, they know it's there. So just some of those things.
Yes.
Anyway.
So that's kind of what we're going to cover for expatriates, because again, and typically from a global perspective, the longer you're in a country other than the U.S., the more likely you are to be truly subject to worldwide taxation in that jurisdiction if they subject their full-time residents to that. Sometimes you might get, as an expat, there might be a couple of years that if you don't remit the actual, like your investment income into Mexico, it won't be subject to tax in Mexico. It's worldwide hybrid, but eventually it becomes worldwide on everything the longer you're in a jurisdiction. The U.S. is just as soon as you trigger residency, it's worldwide. So that's kind of our, and tax home, again, is closer connection to. So where are your vital interests? Are you subject to taxation in that jurisdiction? Are you trying to say you're not subject to tax there? Typically, expatriate tax homes shift within the first year of their relocation.
Let's talk about the easiest asset, right? The easiest asset is cash.
Mm-hmm.
Let's talk about what happens if you keep money in Mexico. You have a bank account,
Yeah, right. Mm-hmm.
Or you might have a financial account.
Right.
It could be a bank account. It's in a financial account of some point. Can you talk a little bit about the filing requirements for that? Because it's easy to comply and expensive if you don't.
Yes. So there's what we commonly refer to as the FBAR, or Form 114, which is the Foreign Bank and Financial Account Reporting Form. This form is you must report non-U.S. banks to the IRS on an annual basis if the highest balance in the accounts exceeds $10,000 at any point during the year. Now that sounds relatively easy, so I'm going to give a couple of examples. The first is you have one bank account and you have a peso amount that when you the highest peso amount when you translate it is $6,000, okay? You have a bank account, you would not have a disclosure requirement for FBAR purposes if that's the only account you have. Now, if you decided you didn't like Bank A, and so you opened up an account at Bank B and transferred that same amount of money from account 1 to account 2 and closed the first account, according to the calculation mechanism for this filing obligation, you now have the equivalent of $12,000 in the bank accounts, even though you've never had more than $6,000 actually there, and you have to disclose. So we try and do a fairly basic example there. So shifting of funds between accounts ends up causing potentially filing requirements. We often have our clients file even if it goes below the $10,000, if it could be fluctuating, so not take a year off. Why bother? It's a very easy form to submit, but you have to make sure you file. If you get caught for not filing and the IRS decides to impose their penalties, the penalty for a non-willful failure to file, so I just didn't know about it, it technically starts at $10,000 per account that you did not disclose, and they can, if they decide you're willful, go up to 50% of the account balance. If you've triggered a filing obligation because of an account, and then you also have another account that is zero, you have to disclose both accounts. That's the other complication matter. So it's very expensive not to comply, and if you are being legally and tax responsible, there should be no reason why you would decide not to do it out of concern that the IRS would see this.
Maybe that's just another way of saying it, but I can't think of any reason why you just wouldn't report all of your foreign accounts that don't have some bad reason to go with not reporting it. So we just tell people to report them all,
right,
because there's really no reason not to.
Absolutely. And the other thing to keep in mind for anybody who's considering going to Mexico or going to acquire property and needs an account, Mexican banks have probably all signed an agreement with the U.S. government whereby they will determine that you are a U.S. person, and they will disclose to the government that they have U.S. persons with accounts with them, and therefore the IRS can actually find you now under there are two sides of the FATCA regime. This is the banking side of FATCA. They can find you. So that is a new.
The other thing that was a surprise to me was when you told me it doesn't necessarily have to be your bank account, right?
Correct. If you have an account jointly with somebody else, like your mom lives in Mexico and you get put on that account, that is an account you now have to report. If you have a bank account that
even though it's not your money, right?
It's not your money, but your name is associated with it, and you can do something with the account. The other is that you have signature authority on an account. So maybe, and this happens with expats, maybe the business that they're working for needs them to be able to sign on the bank accounts for the business on occasion. Then they will have to potentially just, if it exceeds the filing threshold, they have to disclose that bank account as well. They do get to say, hey, it belongs to someone else, but you do have to disclose. So it's a lot of paperwork because people did deliberately abuse the system. And so as a result, everybody who didn't abuse the system is now caught in the web of, we have to do all of these disclosures.
Loma,
so the bad stuff started.
Yep.
This is actually Amber, and I was going to chime in and say, I actually, just because I have a company in Mexico, obviously, and I didn't realize it was if you were a signator on account. So I, just as a personal, I was filing my FBAR for all of because my accountant said, do you have any personal accounts in Mexico? Well, yes, here are my personal bank accounts. Well, I, at first, wasn't filing. I was a signator, obviously, on my company accounts, and those also needed to go on my FBAR, so I had to do that correction. But I wanted to make special note too is sometimes we have clients who are in condominium associations and they're on board. So I just want to kind of bring this in case this rings a bell for anybody. If you are a signator on your condominium's account because you're a president or a secretary or a treasurer, that should be on your FBAR, correct? It just wouldn't be,
Yes.
You have to disclose that it's not your income.
Correct. Yes.
So I guarantee you there's somebody in the room with us that has this question that I'm going to ask you. Well, I didn't know I was supposed to do that. What do I do now?
So what you do now is that you should get this cleaned up. How exactly you do that depends on facts and circumstances. If you had a bank account like a signature authority, the IRS has some special guidelines on how you go and do the back filings. You turn them in under a special regime and say, here they are, I missed it. Basically a voluntary disclosure where there's no tax consequence to you. The other one would be is if you had a personal account that you failed to file on, but you either didn't earn any income or you've reported the income on your return, you just didn't tell them about the bank account. You can do the same thing. You complete those bank accounts. You submit saying that no income was missed, and the IRS has said that they will not go after you at that point. If you determine that income has been missed related to this bank account, then there are a couple of different ways to go. There's the formal offshore voluntary disclosure program. That is the one where what you have to do is you amend prior tax returns to pick up the income, you do the bank account forms, you submit that you want a background check by the government, and you are saying that you will pay in up to I think it's now 27.5% of the highest balances in those accounts that you miss. So it's very complicated and can be very expensive.
Not as bad as you think, though, because my experience is when I open a bank account in Mexico, they charge me to keep my money there instead of paying me interest.
Okay.
So there aren't too many that usually pay unless they're investment type accounts.
Okay. Well, so hopefully that means that in a lot of cases it's not that income's been missed.
And then the other point, I think, is that, there's going to be some, well, what a pain. I don't want to do that. And the answer is, well, it's a shame that you don't want to do it because just because you don't want to do it doesn't eliminate the penalties.
Right.
So it's probably best to do it, even though it is a pain, because once you get caught up, you're out of trouble.
Right.
Right. And it's easy to stay out of trouble once you're out.
Right. The other method is what's called the streamline program, where the penalty that you pay is less or zero, depending on if you're an expat, you might be able to get to a zero penalty. You still file the back filings, etc. You don't have quite the same tax protection as the former program. So if there's anybody out there who's like, I have a problem, you should talk to your accountant, give us a call.
Oh,
and again, we have had a client actually sue her former accountant for not doing the FBARs.
Yeah.
And that covered her cost of having us do the submission for her, and actually some, if not all, of her penalty.
The insurance company paid, didn't they?
Yeah. So it is something you want to clean up. And as I said, increasingly, I actually had a client that received a notice from the IRS. She had a brand new bank account that somehow disconnect. We didn't find out about it, had zero balance in it. She received a notice from the IRS saying you didn't report this bank account. And she reported like $2 million in other accounts, but this one she's gotten a notice on. So they will find you, and the banks may choose to say you can't bank with them if you won't sign that you will be in compliance.
And they're good. The procedures they use to find you are getting better and better.
Yep.
I got you off topic.
So there we go.
Go to real estate,
so
but that's what people trying to turn in.
Yes, and part of that was on the last slide, so we've just covered something else. So we're going to focus now on acquiring real estate outside the United States, and there are kind of two main things to consider. The first is, why are you doing so? Is it for personal reasons, like a second home? It's an investment property. You anticipate the land values in Mexico are going to continue to increase, so let's make a good investment here. Or are you actually going to invest in a rental property outside the United States? So why are you doing it? And then the second thing to be considering is, how do you want to own that? Is it directly? You own it personally? Do you own it through some form of a U.S. entity, or do you own it through a non-U.S. entity? Now, something to keep in mind, as I understand it in Mexico, is you potentially don't have a choice. You may need to be required to own it through a fideicomiso under local law. So you don't have a choice. Now, you can go and put something else in there that they own the fideicomiso interest, etc. But that is a situation where you don't actually have a choice on direct versus indirect. You're forced to use indirect.
As a non-Mexican citizen.
There we go. Okay.
So it's either a fideicomiso or a corporation.
The
corporations have to have a business purpose, as I understand it.
There we go. And that was one of the discussions. So, and that's, I think, if typically you go the corporate route if you're planning on renting it out. Okay. So personal acquisitions, just a couple of things to consider. Some of this utilizes new tax law. Real estate taxes on a home that's located outside the United States are no longer deductible for itemized deduction purposes.
And that's 2018?
2018. So you don't get a real estate tax deduction. Now, of course, but of course you potentially don't really get one anyway because you've been capped. So not as big of an issue maybe as it could have been.
Well, but if it's your only property,
then yes, it does. It can be costly.
What Loma's talking about is there's a provision under the 2018 Tax Act that limits state and local taxes to $10,000 or less. So if you've sold your U.S. home and you're not paying taxes to a state in the U.S., this is a real loss of a deduction that you would have otherwise had before 2018.
Or you're actually an expat who has a home in Mexico that is no longer, so you wouldn't have any state taxes, you no longer have real estate taxes. So then it's deductibility of mortgage interest. We just wanted to reiterate that it doesn't matter where you get the mortgage from. If it meets the requirements of a mortgage, it's guaranteed by the property, etc., then it can be a mortgage from a Mexican bank or a U.S. bank or a China bank, whatever it might be. It still qualifies for mortgage interest deduction. Now, effective with 2018, we have some new caps on that. So if your total mortgages exceed $750,000 as of 2018, you may have a limitation on how much of that interest is deductible, depending on when the mortgage came about. So just remember, combined mortgages over $750,000 could cause an interest limitation to you. But again, it doesn't matter if it's a mortgage on a Mexican home or a U.S. home or some other jurisdiction.
But I want to throw something in here, because when I bought my home in Mexico, I went to my bank that I do a lot of business with, and I asked them for a mortgage on my Mexican home, and they said no. They said, we'll make you a loan. We'll even make you a loan unsecured. We don't want your Mexican property as collateral. And that caused a problem for me, because if I clearly was using the money to buy the house, or in my case, build the house. So it was clear that it was home mortgage or home financing, right? Mm-hmm. But without a mortgage, I wouldn't qualify for that deduction.
Right.
So with the help of my U.S. real estate attorney, who specializes in Mexican real estate, we actually created a mortgage, the equivalent of a mortgage, and I provided it to the bank, and they said, despite the fact that they didn't want it, I told them if they wanted to make the loan, they had to take it. And as a result, it did become deductible for me. But without that, I mean, if you're getting loans against something besides, so if you take a loan against an investment portfolio, or if you take it against something other than your U.S. residence, right, or your Mexican residence, it's not going to qualify for mortgage interest.
Right. So for that's it for the personal acquisition. So that's why we wanted to highlight those two areas. If it's a personal acquisition, then if you wanted to just do it for an investment activity, and in this case it's buy and hold is what I mean by investment activity. Again, the real estate taxes component still there. There is or was an election whereby
so even if you're renting in Mexico now,
renting's different.
Got it. This is
he's skipping ahead. Yes,
sorry.
Investment. So there is a there was an election available for those who held property. Sorry. I must have bumped something. There we go. That you might be able to capitalize that real estate tax to the basis so that when you sell, you don't have to pay tax on that gain. We have not had an opportunity under the new rules to look and see if that's available, given that you technically can't take a deduction for this real estate tax anyway. But there is a potential of that being available, so it isn't really money out the door. In this case, under the interest expense tracing, and to use Joel's example, if he had just bought this for an investment purpose, the loan that he got in the U.S. where he could prove that the funds were used to buy this property would have been okay under the investment interest expense tracing. And then this interest is investment interest expense on your tax return. Whether you get a deduction for that depends on if you actually have investment income sufficient to absorb this, and if you don't, then it carries over. So one thing to keep in mind for the acquisitions, particularly under personal and investment, is you have to look at the exchange issues. When you buy a property that is not a business property outside the United States, your currency is still the US dollar for this acquisition. So you buy it for an amount in pesos, you determine what that US dollar value is on date of purchase. When you go and sell, you do the same thing, and then you compare the purchase price and sale price in dollars to determine any gain or loss. And we had situations with individuals up in Canada 2 years ago that where the exchange rate had fluctuated so greatly that year, they had Canadian dollar losses and US dollar gains, which caused consternation by people. They were not very happy when we gave them that answer. So you want to keep that in mind, that in both of these cases, you must lock everything into US dollars to determine your gain or your loss.
We had that in with some Chinese.
Did you? Yes, we did. Yes, the exchange rate had fluctuated. So we'll move now to rental activities. There again, there's all sorts of things to consider. So business versus personal use. If it's 100% business, you don't have to worry about personal use, obviously. For personal use days, if the question is how much do you use it for, but if you have personal use, you're going to end up having to prorate your expenses and then determine whether or not the remaining business expenses are actually deductible. And if your personal use exceeds 14 days or 10% of the rental days, you're very limited on what you can take as deductions on your tax return. So I'll give an example. You take your income that you've earned, you then subtract any interest or real estate taxes, because you do get the real estate taxes now because it's a business. So you deduct the business portion of those. That either leaves you with an income or a loss. If you've got a loss at this point, then you stop. Because you cannot take any of the other deductions that are available to you, depreciation, etc. If you still have income, you then look at the business pro rata share of the loss of other expenses, and you can reduce the remaining income down to zero. If you still have income after those expenses, you can now use your depreciation to get you to zero or wherever you end up being left off. So that's if you have a large portion of personal use, but it's still basically a rental operation. If you're under those days, you determine your business use and that you are allowed to go into a loss position. Most individuals who have rental properties with losses are not eligible to claim the losses on their current tax returns, because of income limitations, passive activity rules, etc. But those losses do carry forward for you. And so in the future, when you actually sell the property, then those losses get triggered. So you get an ordinary loss in the future when you've got hopefully a capital gain on disposition. So you have to worry about your personal use days. Now, if you only rent it for 14 days or less, like Minnesotans did for the Super Bowl, you don't have to report the income or the deductions. So that is another little loophole.
So that's a big deal. I want to spend just a minute on that. So that's the Super Bowl rule. I'll tell you a story about it before we end here. But for those of you who don't really rent your property, and one of the reasons we have our Mexican properties is to be there during the holidays. But if you want, that's probably also a primary rental time. So if all you did was rent for Christmas and New Year's, or you rented over spring break, Easter kind of thing, and it was for less than 14 days, and this is any rental property, whether it's in Mexico or elsewhere, you don't have to pay tax on that income. So if you can get a lot of money for those time periods, that's tax-free income, and it ought to be used in the United States. In the United States, good point.
Yes.
Not Mexico. The story I want to tell you is a true story about when the Ryder Cup was held outside of Boston a number of years ago. A woman was approached at her home by a chauffeur driver dressed appropriately, driving the big black car, and he came to the door and he said, "Ma'am, I have clients who would like to rent your home for the week of the Ryder Cup." She said, "This is not a rental property. This is my home. I'm not going to, I have no interest." And he said, "Well, before you make up your mind, I'd like you to at least consider it. Here's a memorandum that says that any money that you would receive for renting your home during that week isn't taxable. Feel free to call your tax advisor," which of course is why I know about it, because the tax advisor is a friend of mine. He said, "And then I'd like you to look at this piece of paper." And it was a check signed for $1 million.
Holy cow.
And she did rent her home out for the week, and she did get $1 million tax-free. And by the way, the tenants for that week were the group of Michael Jordan, Scottie Pippen, and a number of the gold medal dream team. And that's where the money came from. So it's a great opportunity if it fits for you.
There we go. Very interesting. The other item is whether or not, from a U.S. perspective, this is actually considered a rental activity or a business activity, and this leads in a little to having a foreign business activity. Rental activities, what get reported on Schedule E on your form.
Okay, thank you. Then I guess I'll start my spiel on some of this again.
I think Michael Jordan was more important than Scottie Pippen.
Oh, now. So everybody, all of a sudden I glanced over and saw that the phone was no longer had any colored lights on it. So, okay, so Joel was sharing that the being less than 14, if you only rent for less than 14 days, you then there's special rules. So just clarifying, did the long-term rental versus short-term rental, Schedule E, Schedule C, did that come through or not? I'm trying to...
No, we haven't discussed that.
All right, so from a U.S. perspective, let's assume that you have rental activity, and then there are typically two different ways it gets reported for U.S. income tax purposes and where it gets reported on the tax return. At the end of the day, rental activity is going to be subject to ordinary income tax rates, and if it's considered long-term rental, which is that the average rental period is 7 days or more, it goes on to Schedule E, and I might be actually back at this page. Schedule E, so it's definitely rental. If it is that you either provide a great deal of services related to the rental, so like a bed and breakfast or a hotel, then it is definitely a business activity, active business. If you have short-term rentals, which is averages 7 days or less, then technically this is considered a business. So this would be like your VBO and so whatever, yes. And so the difference is they're both subject to ordinary income tax rates, but if you've got an active short-term rental or the bed and breakfast option, you're also subject to self-employment tax here in the United States. If you have the short-term rental, but essentially you're not running this operation, you're using a management company, etc., this is often reported on Schedule E as well because it's passive and it's subject to those passive activity rules, the same as a business would be.
Schedule E is the rental schedule.
Schedule E is what people consider the rental schedule. Schedule C is your business schedule. Did I go through the difference between the short, if you've got personal use and it exceeds 14 days or?
No, no,
Oh, okay.
That's new information.
So the big picture area on this, and I'll flip back and forth here, is so personal use of a rental activity, you do have to disallow certain of the expenses because they're personal. Okay, so you prorate those. The question now is if you have a rental and you've got significant personal days, greater than 14 days or 10% of the rental days, then you have an issue that you may get your expenses limited. The IRS doesn't allow you to go below zero for the activity unless you're going below zero solely because of interest and real estate taxes. So you have your rental income. You then work out what your business allocation is of all of your other expenses. Your first step is you would take your business income less your allocable interest and real estate taxes. And if that is positive, you get to keep going. If it's negative, you stop, and that's the loss that you report on the return. If it's positive, you now look at the business expenses other than depreciation that you have remaining. If you can use those expenses to reduce that remaining income down to zero. If it goes below zero, then the expenses aren't deductible. If you still have income after that, then you can now look at what depreciation will give you. And then, again, you still can't go below zero. So that's if you have the significant personal use on a rental property. If you don't meet this test, then you are allowed to create a loss due to your activity. Typically, or more often than not, our clients have rental losses that get suspended because their income levels are sufficiently high or they're not active enough that they don't get a deduction. What happens then is that loss is carried forward until you have other passive type income, or when you sell that property, then you are able to offset the capital gain. So you pick up the gain at capital rates, you still get your ordinary loss, so it's generally very favorable.
So 9 out of 10 people that we do tax for that have a vacation rental that they use themselves fall under these rules.
Right, yes.
Some people stop going and they just rent it and then they fall out of these rules, but most of the people we work with use their place and as a result are subject to these rules. And it's not that they're complicated, they're just sort of step by step, tedious.
Tedious. So it's for the number crunchers of the world. I hype on this slide that depreciation is available on a rental property, and the key here for those who are used to U.S. rentals is the lives are different. You calculate all of your income and expenses per U.S. rules to do the U.S. tax return on the rental. And the depreciation lives, instead of using the maker's lives, you use the ADS lives. So to put it simply, a residential rental property that is 27 and a half years, if it's a U.S. property, is 40 years straight line for foreign rental properties. So that's why it's on the slide. I think I've covered everything that. The last item here is this elect treatment as a qualified business unit. So if you actually have a rental property outside the United States, you can make an election to truly treat this as its own business operation. You don't have a legal entity or structure around it. The advantage of this is it means that you are tracking your income and expenses in the currency that they're occurring, the peso. You then calculate your income or loss under the U.S. rules, translate that to U.S. dollars based on the average exchange rate for the year. So you shouldn't be being affected by unusual fluctuations. Technically, as a U.S. person, otherwise you would have to take every time you incur an expense in Mexico or recognize income, you'd have to translate it on that day to U.S. dollars to do this calculation.
Do you have to elect that every year?
You create the QBU at the beginning, and then that is your operation. And so you mark that it's a QBU on the tax return, and provided you're following the treatment, You should be good.
So that's on the form. QBU is on the form. So that's
You're
what
right.
that is.
So we've put like rental property and then in brackets QBU.
Okay.
Your depreciation is also calculated based on the Mexican basis for you, which is good because you also don't get affected by exchange fluctuations.
Which is the basis you bought the property at originally, right?
Yes.
In the first year.
Yes. Yeah. The other area is if you have the U.S. at the end of the day ultimately will make you compare what is the U.S. dollar value that you sent to Mexico to get your business activity compared to what you ultimately got back. And if you brought back more money than you sent, then you have a gain that is taxable. If you bring back less, you've got a loss that's not taxable. The item here is that if you were to sell rental property 1 to buy rental property 2, you're still in the QBU, so it does allow you to kind of defer any potential exchange gain on just simply because you sold the property.
For U.S. purposes?
Yes.
So it's almost like a tax-deferred exchange without all the detail.
Well, you still have a gain if you've got a gain on the transaction in pesos, but you don't get hit with exchange gain recognition is the key.
Exchange gain.
And
okay.
Mortgages, if you have a non-U.S. mortgage, this is very beneficial because there are very, very special rules on translating mortgages, and if you can track the mortgage in non-U.S., it generally is very favorable. All of our clients that save their money on an annual basis. Okay, so we've sort of hinted at some of this because local jurisdiction requirements on, if you just choose to, if you've got a rental property, how do you own it? Why might you own it non-personally? Well, in Mexico, you'll be potentially required to, unless you may be buying a property in Mexico City. There are other considerations such as legal and liability protection. Many people in the U.S. set up single-member LLCs in order to own property just because they want to try and protect their assets. So that could be a reason, particularly if you know that this is going to be like a regular rental property and you don't want there to be a chance that they could come after you. You need to look at whether or not you've got protection in Mexico under that if you're using a U.S. entity or if you'd be wanting to set up a Mexican entity. So there are legal considerations. Sometimes you can have tax preferential treatment. A resident entity sometimes gets better tax rates, or maybe you don't have to do withholding if they're the one who owns the property. Joel and I, when we realized that we'd lost everybody, were discussing that historically I haven't seen U.S. entities used to own the property, but Joel has. And the example he used, and we were asking you a question, Amber, is if you own this property through a U.S. partnership, for example, and then you decide to sell the partnership interest versus the property itself to somebody else, original advice and what applied at the time was from a Mexican perspective, we're selling a U.S. asset, so Mexico doesn't have a triggering event when the indirect owners of the Mexican property change, but the direct owner doesn't change.
So I was told that if we sell our membership interest in a U.S. LLC, and that LLC owns Mexican real estate, that's an American transaction and not Mexican. And I think, Amber, you mentioned to me when we talked about this a couple months ago that the Mexican government is not recognizing that strategy anymore. So I just wanted to know if you could pop in there on
Sure.
that and if it's the case.
Sure, and that is correct. So Mexico, that scenario translated into Mexican, the Mexican framework is a U.S. LLC, right, as you've suggested for liability reasons or whatnot, then is the primary beneficiary of this fideicomiso trust, correct?
Right.
And so in what you're describing is instead of actually selling the property from Amber Pierce LLC to new owners, either private name or their LLC, instead you would be changing the membership within Amber Pierce LLC, and now it's a new single member that's not myself. And before that was not a triggering event in Mexico. Now it is. So what happens is because I'm out of the picture as a seller, in the trust bank requires that there be somebody on record as the record holder and the authorized user of the trust, and that changes. So when that changes, that's how Mexico catches up with it. And they say, you know what, the spirit of this is that the transfer of rights to the property has changed, and therefore either way the acquisition taxes and sales taxes are due from the parties. So it is a triggering event, and it is no longer a way to avoid the taxes that go along with the sale.
Well, I think that's completely unfair, and it should have changed after I saw it.
Well, but I will contribute that the U.S. has done this since like the 80s, if not earlier. So it's just the rest of the world catching up to the U.S. schemes.
And this was a states kind of thing, right, in the U.S. So if you saw, this is what people would do to avoid having their property taxes go up. They would sell the partnership or the LLC membership interest and not the property. Yep. Okay, let's go on.
Okay, so I will talk about some of the, so the key item from a U.S. income tax disclosure aspect is if you have ownership through a non-U.S. entity of some form, you more than likely have some other disclosures. And what I'll do for right now, because we've got a good lead into the next slide, is I am covering that at the end. So keep in mind that having ownership in anything outside the United States, you're going to have to disclose it in some way, shape, or form is a pretty easy way of thinking of it. But let's talk about a little bit more. Whoops. Oh, I guess I skipped a slide. Sorry.
I think that's okay. I think we covered that.
Yeah, indirectly. So local country compliance, and we've sort of hinted at it, but basically failure to comply because nobody does it in that jurisdiction. One is a fallacy because people do comply with the laws, and it's very risky. There are ways for the Mexican government to work out that you are operating a business from their perspective, or that you have foreign source income, in that case Mexican, from their perspective, domestic source income, and eligible for them to claim tax on. Couple of items that the risks in, if you get caught, you've got paying your taxes, potential jail time. You also have the potential of, instead of being able to pay tax on a net basis, there is a chance that they'll decide, okay, fine, we're going to treat this as you have gross income and no deductions. And so we're going to take withholding tax at some high rate, and you won't get deductions on it, which means you are going to be out of pocket. You will not be able to absorb a withholding tax on the gross income against your U.S. income. And in talking to Amber, and I might let her step in, there's actually been an increased, there are situations now where like management companies are actually being required to do some level of withholding on your behalf, so the authorities definitely know about you.
Yes, that's correct. So in the state of Quintana Roo, they have passed a 3% occupancy tax, and that occupancy tax is being, the occupancy tax has always been there, but it was only applicable for hotels. Now it is applicable for vacation rentals, and it is now upon property managers and individual owners, if there's no property manager involved, to pay that state tax. So at this point, your rentals are on record. So if you're not paying the federal tax portion and you're paying the state tax portion, it's only a matter of time before the federal government tunes into the state's records, right? And so you definitely don't want to be out of compliance with both the federal and the state tax authorities.
So that's kind of our message. And again, we don't handle Mexican, we don't do any non-U.S. filings because my attitude is we aren't those experts. But you find the party or the affiliate that you feel comfortable with, and you talk to them, and you may get differing opinions on, again, well, this is what you're supposed to do, but nobody does it. You have to weigh the risks of going with non-compliance because supposedly it's okay to do. We had sort of discussed all the loan interest items before, so we'll skip. So now we're to the disclosure requirements. I've mentioned A.M.P.I already. That's the having a bank account, and that does include investment accounts, just to clarify. The next one is the FATCA, and this is our tax return FATCA, Form 8938. This is where you have to report foreign financial assets. Now, that does include the bank account that you have direct ownership of.
So you have to put the bank accounts on that one too?
You have to put the bank accounts that you have direct ownership of. So a signature authority would not go on this, for example.
So that's the difference.
That's it now, but it expands to more. What this also includes, it's now, the definition is foreign financial assets, not financial accounts. So what is a financial asset? Simply owning a property in Mexico that you rent out, the actual rental property itself is not the foreign financial asset if you own it directly. The rental contracts are your foreign financial asset. So if you have rental income of $50,000, that is a foreign financial asset. Okay. If you
own Airbnb,
that's still we would report that as being a foreign financial asset because it relates to the foreign property. Of course, there's lack of clarity here from the IRS. We all just know rental contracts count.
So would you just say I have a contract through Airbnb or VRBO? Or do you have to put every time somebody rents?
We typically put various renters and report the amount of gross rental income that's on Schedule E.
So it's not that burdensome.
It's not that burdensome. But if you choose to own it or are forced to own it through another entity, then that entity has now become your foreign financial asset. So if you had
a Mexican corporation.
A Mexican corporation. The fideicomiso in itself could be a foreign financial asset, except that the IRS has given us some clarity that they aren't considering a fideicomiso as something that needs to be reported as if it's a separate legal entity.
So up until 5 years ago, maybe, I used to do a 3520 and a 3528, and I would say 80 to 90% of the questions didn't apply, and then ultimately they figured out that it didn't apply and they stopped making us file them.
So a fideicomiso, if you look at how it's structured, it technically looked like it would fall under being a foreign grant or trust. And that has the last reportings that are on here. The IRS has provided guidance that provided you are essentially doing what, to our knowledge, all owners are doing, then you do not have to treat it like a foreign trust, which means you don't have some of these extra reportings.
And then items 3, 4, and 5 are just the forms that you have to file if you have one of those. If you have a foreign corporation, you do the 5471. If you're a partner in a partnership, you do the 8865. A disregarded entity for U.S. purposes is like if you have your own LLC and there's only one member. I don't know if Mexico has such a thing.
No, but you could have done, that's the one thing we didn't cover, the check the box election. So if you, for whatever reason, are forced to set up a foreign corporation and you really, really, really want to include the losses on your U.S. income tax return, you most likely can choose to treat it like a disregarded entity. Historically, though, we don't find that that's done with rental activities. You follow whatever the ownership method is, because otherwise you have a problem, as we mentioned before, the timing of the income recognition in the two jurisdictions will cause you problems with foreign tax credits. Now, I just want to clarify on the ownership of the 5471 and the partnership, because everybody's probably sitting there going, but I have ownership in a brokerage account of, 3M Mexico. If you own 10% or more of a foreign entity, then you most likely have some level of disclosure at some point in your life on one of these forms. If you own more than 50%, then you have an annual obligation. Ownership does attribute between, if a husband and wife each own 50%, you are each deemed to own 100% for reporting purposes, just high level. The FATCA form is the one that is much more common, and I just wanted to give you the filing thresholds. So start with, you look at the value of these assets, and if you are single and they add up to more than $50,000, you need to go check and see whether or not you might have triggered the filing. If you are married and it exceeds $100,000, then go look at the rules. They have rules at the value at the end of the year versus the highest value. So I'm giving you the lowest threshold that you might trigger this obligation. This is a form that goes in the tax return. Again, it is 100% disclosure. If you are reporting all the income, etc., like you're supposed to be, all you're doing is telling them yet one more time of something that's already in your return. But if you think about it, they don't get a K-1 from a foreign partnership. They don't get a 1099 div from a corporation, so they want something to be disclosed to them so that they know about it. And again, the penalty starts at $10,000 if you fail to fill out this form, and you should have. All penalties on foreign disclosures pretty much are $10,000 or more if you fail to do them. So that's always my scare tactic, that you really want to be in compliance because it's really expensive in the U.S. If the IRS wants to stand with their non-willful failure to file penalties, it can get very expensive for just simply choosing not to.
So, Amber, did all the questions come in while we were disconnected?
Yeah, so there was one question that came in. I think that we've only got, let me look. I think we've only got one that somebody wanted to catch up on. And this was something, bear with me, let me scroll up to get back to it. And that is, oh, nope, there's two. This is sent in from an expat, obviously living in Mexico, and she says, I have a mail forwarding service. So when I file my U.S. taxes, do I create a problem filing from that address as a non-resident?
So on the U.S., assuming on the U.S. tax return you're using a U.S. address, but you're claiming that you're an expatriate, if that's what it means, that's fairly common because people don't want to use a non-U.S. address either because it's temporary, like they're only going to be there for 2 years, or more commonly, they don't trust the mail service in that jurisdiction.
That's quite likely.
On the form, assuming you're claiming the foreign earned income exclusion, you do disclose what your actual foreign address is on the form 2555, and or who your foreign employer is. So that should be adequate disclosure. I have not had.
Hang on. What if the employer's not foreign? Like the example I gave earlier.
Well, then you definitely probably, in the ideal, you want to be disclosing then that foreign address. You can do it on that form. I have not had an expat who uses a U.S. address receive a question on claiming the exclusion when we fill out all of the appropriate questions at the beginning. If you're only claiming the foreign tax credit on your tax return, then there is no other way to show this. But in theory, you do disclose it because you're saying that I have earned income outside. There is no W-2, and you can input the information in most softwares that show that that employer is a non-U.S. employer or has a non-U.S. address. If for some reason everything on that tax return shows U.S. and you're truly an expat and claiming foreign tax credit only, which happens for people in Germany, for example, you just need to keep your records to show that you really live there, you've got a German tax return, etc. If it were to get questioned. Again, I have not had any of my German guys get questioned on being able to take the foreign tax credit.
What's the second question?
Great. The other question is just more of a clarification. And he is saying, okay, just so I'm clear, I own a property in Puerto Morelos. And actually, in this case, it's a property, and he hasn't even built a home on it yet. It's a lot. Okay. And he says, he says, I don't plan to rent. He just owns it, and he owns it in fideicomiso. So is there a reporting requirement in that case because he has this foreign earned property? And I think we talked about this at the end.
Today, with the IRS's clarification, no, you do not have a special disclosure. It's not a foreign financial asset. It doesn't fall under the foreign trust rules. So you just own it. And so you should be fine with no other disclosures.
Perfect. And I believe that is, okay, we've got one more question that came in and says, I rent 90 days per year. I spend 90 days a year there, and the rest it is empty. So I'm supposing she's going back to, she says, is this still a business? I rent through VRBO.
Yeah, this would be, you have rental activity that's reportable because you're renting for more than 14 days. And so you have to pick up the income and then expenses at this point, it would be expenses to getting you down to zero if they're enough to wipe out your income. If you don't report, your small risk is that the IRS would actually say this is a hobby versus like a business or a Schedule E. And as of 2018, that's a really bad answer because you pick up 100% of the income and get none of the expenses because they go to Schedule A. We used to go to Schedule A.
So this is one of those examples we talked about where you go through each tier of expenses, right?
Right.
Until you wipe out all the income.
Yes.
Yeah, unless you don't, in which case you just keep going through it.
Right. And so we would.
So for example, it's 50-50, right? Yeah. 90 days use, 90 days rental.
And the one allocation question there, and this is variable, is the other 180 days that it's not rented. Is it just that it doesn't get rented, as in it's available and just doesn't get there? If that's the case, then you have more. You can argue that it was available for rent the whole time. So
you would say she might treat that as 75%
rental
because it was available
for rent. So that's a distinction. So so if it's available for rent, then you can count that towards business days.
Perfect. Okay, I actually have a question for you, and this is something that has come up with some of my clients, and I try not to offer tax advice, but while I have tax experts on, I'd love to pass on the question that I get asked all the time, and my response is always, you need to talk to your accountant. There are some clients who have a rental business set up in the States, so they have an LLC, right, that performs those rental business activities. Their house is owned privately by them and fideicomiso in Mexico. And they may spend more time than the 14 days, private time in that house. And so what they do is to not exceed that is they actually pay a full rental rate into their LLC for the time that they're in the house. So like if I'm only allowed X amount of private days in that house, then any more of those days they pay the rental rate into that LLC like they were a paying client. That always seemed odd to me. I mean, I get why they're doing it. It seems like it's kind of a roundabout way of sort of avoiding the spirit of what's happening. So do you guys have any opinion on that as to whether that's a legitimate way to avoid the limitations of personal use?
Yep. You're still subject to having to allocate the expense. Well, if you have any personal use, you still have to allocate. What they're doing here, though, is allowing themselves, I'm anticipating that their expenses exceed their income. So what this is allowing them to do is treat that as a rental day, and therefore they would get to have the losses that would carry forward on their tax return or go against income. And it is the personal days, by definition, it's any day that you don't rent it for the full fair market value. So if you have
they're renting from themselves at full fair market, that's a rental day.
That's a rental day.
Okay.
And that, and personal use does include if you let a friend stay there for free or at half price, then that is not a rental day according to the definition.
Gotcha. Okay.
And I'm guessing in your clients' cases, it's just that they have enough expenses that they want to be able to carry forward those losses, and that's the only way they can do it.
Gotcha. Okay, that makes sense. Thank you. I think, does anyone else have any other questions? We'll see. That takes care of all the questions that were in the chat. I think that is probably it. Loma and Joel, bear with me just one second. I'm going to pull back so that I've got my slides back here. I'm going to take the presenter baton back. And in wrap up, if nobody has any other questions, first of all, Joel and Loma, thank you so much for all the information today. I'm sorry that we had the audio issue, but thanks for being champs, and I'm glad we got to fix it. I appreciate all your time. If there are, if anybody has any questions, obviously, what I always learn when I sit through these is that having a tax accountant professional and their advice is enormously helpful. There's a lot of caveats and things to track, but it's always helpful to put it on your radar so that you can go back to your tax professional, or certainly, I can't recommend Lurie LLC enough in their services. So definitely, it always underscores for me how important it is to have a tax professional that's familiar with these types of situations so that you are in compliance, because the oops factor is pretty expensive if you're not filing the reports that you should be.
That's right.
what I want to tell everybody is that I've had this webinar recorded. So it will take several days for the service to process the video, and we'll upload it on YouTube, and then everybody will be getting that link. That was one of the questions. So yes, we have recorded it, and you will be getting a link to this in your email. So keep your eye open for that. And then,
will you edit the dead air?
I am. I'm going to cut that out so we don't have to sit through the dead air. And then the other thing is that, you know, this is one of various webinars that we hold throughout the year. And so, you know, anybody that is interested, one way to know what webinars are coming up is to go to our blog, portamorelisblog.com. We always announce them there. You're able to subscribe in the right column. There's a box there to subscribe. You'll be getting an update in your email anytime we announce a new webinar. But then also, if you guys would do us the favor of sharing our posts in your social media or by word of mouth or in any expat groups that you're in, you know, it always helps to help get the word out. We try to make these as informative as possible for people, and we do put them on our YouTube channel. So when you go to Mayan Riviera Properties, we have a YouTube channel, and so you can see any of our past webinars on that channel as well. And I couldn't invite you enough to share them if you find them helpful. Joel and Loma, thank you so much for your time today. I really appreciate it.
You're welcome. Thank you.
Thank you.
All right, everybody. I'm going to go ahead and log off. You guys have a great day, and we'll see each other at the next webinar. Everybody have a great day.